Right. Good evening, everyone. Thank you so much for joining our webinar this evening. I'm just seeing more guests filtering into the room. I'll give it a little bit more time, but yeah, essentially, I want to be conscious for your time this evening. So we do appreciate you joining. It's a great privilege to be able to speak to the market in Zimbabwe this evening. I think this comes from quite a lot of demand and requests for us to operate a webinar in the region. We obviously do operate quite significantly in Zimbabwe. We have got quite a significant portfolio of clients existing in Zimbabwe, so we're quite well versed with the market. But I think what we want to cover tonight is just some intricacies and some overall consensus of what it entails to look at owning a property in the UK and how to manage that property. We'll go in for the reasons and strategies in the webinar. But yeah, we're going to use this evening as a form of education and provide information from experience that we've had within the Zimbabwe market for you to benefit from that experience going forward. So if we could just quickly jump to the next slide, we'll start off. But just to say thanks to Sophia Kazmi from the Maidwell Group for joining us this evening as our special guest. We do also have another guest I'll bring on towards the end. But just to possibly take you through about who we are as a company, if you haven't heard of Joseph Mews in the past, essentially we're a company that was founded in 2001 by our chairman, Andy Foote, on the screen. Andy was insurmountable actually in the development and regeneration of Birmingham itself, but essentially started off as a property investor himself and has, through his own experience and unfortunately some negative experience, decided that the process could definitely be more fluent and better for the investor. So he set out to found the business that helps clients, property investors, purchase property through a full spectrum of services. So it's a 360-degree approach and helping our clients build portfolios, diversify their wealth, and obviously take advantage of a very strong property market, historically the strongest in the world. So Andy himself has a plethora of experience. He has a significant portfolio himself in the UK. And essentially, we couldn't be prouder to have him as our chairman. We were essentially, through his guidance, part of a single developer for about a decade long, a developer named Seven Capital. We were the sales and distribution part and marketing part of the business there. We grew them to become the third largest privately owned developer in the UK. And subsequently, in the last 3 years, we have rebranded to Joseph Mews. And we now work with more developers throughout the country or the region, focusing on high growth areas and yeah, very strong partnerships. If we can jump to the next slide, please. I think it's our track record that really sets us apart, and it's something we are very proud of. I think in a market, especially of our own in Africa, and just I'm always terrible at introducing myself, I think, in the beginning, just so you understand. I'm Mark Bester, the regional sales director for Joseph Mews in Africa. So our task and our team on the ground here is assisting our clients from Africa invest into the UK. And you want to be doing that with a partner that has done it many times around and is very well versed in the industry, what to expect, and work with the right partners. So in our tenure, we've delivered 4,000 or over 4,270 completed units and properties for our clients. That pretty much took about 43 different developments to achieve. And we've got a repeat purchase rate of about 28% of our clients, whether our clients are purchasing for the first time or whether they're building a portfolio. We're there to try and get them to extract as much value out of the purchase as possible. So it's super important for us to to sell them the correct development in the first spot, or in the first part of the process, and help them extract that value that will grow on that investment to help reinvest and build a portfolio. We've delivered just over 632 million pounds worth of GDV to our clients. So this is a track record we're incredibly proud of, and we do hang our hat on this when we speak to clients that might have never heard of us or experienced the journey with us. If we can jump to the next slide, please. So the business is built on partnerships. We've always made sure that partnerships are key in this, because we need specialists in certain fields of this industry to help us deliver the best. And some of those partnerships you might recognize: Knight Frank, one of the largest PLCs globally. We've got exclusive distribution agreement with Knight Frank in the West Midlands. Any off-plan or new residential development that comes to the market, we will distribute that on their behalf. JLL, one of the biggest as well in the industry. We've got exclusive partnerships with them. Developers like Elevate Property Group, one of the biggest privately owned developers in Birmingham, and has an incredible reputation. But those are just a few of the partnerships that we all deal with. So before you are introduced to any of our properties, you can be rest assured that the due diligence into the developer has been done. The product that will be brought to the market is on spec and in line with market insights that we know will perform higher than average in the UK and help accelerate the growth of your investment or your portfolio. And this is very key to us in terms of delivering a high performing property portfolio in the UK. We jump to the next slide. We'll take you through what our service actually provides, and it is why our clients enjoy us. I would say most of our clients are investors, especially my clients throughout Africa. We know that there's a concern being as far away from the property as we are, but essentially we know that our team on the ground in the UK has it all covered. So it's a 360-degree approach that we offer our clients, from educating you, informing you on the market, to chatting about specific properties that might fit within your strategy or your objective of getting involved in UK property in the first place. We will hold your hand through that process. So through panel solicitors that we work closely with, that will represent you legally in the UK, to make sure that you understand your sales agreements you're signing and getting involved with, to make sure due diligence is done on the actual developments and feedback any information to you that you might need to know. Obviously, we hold your hand through that process. Mortgage brokers, you'll meet lovely Sophia later, who we partner with at the Maidwell Group with regards to our clients that want to purchase with finance. And then we also have our managing agents who will introduce our clients to prior to completion of the properties. Once our team's done the checks that the properties are all to spec, the way that we have marketed and sold them to you as a client, that those are ticked off, we hand over to a managing agent who will then obviously market the unit, take applicants of tenants on board, vet those applicants, and make sure that the best ones are put in front of you for you to enter a lease agreement with. And then from there on out, the managing agent will take care of collecting the rent, the maintenance of the property, all while we are still involved in the conversation, keeping them accountable for their service to our clients, where we will be giving annual portfolio overviews of how the properties perform, what the markets are doing, how we could best streamline the portfolio if we can, but also a little bit of peace of mind. We've got after sales, which is also the fact that all of our developments that we sell come with a 10-year build warranty, which obviously takes out the unknown in terms of maintenance for at least 10 years. You know that you can sleep peacefully at night knowing that that's all covered. So it's a 360-degree approach that we offer, and yeah, it is something that will streamline the process for our clients as much as possible. If we jump to the next slide. So if you've got any questions or anything you want to mention, if you look at the bottom of your screen, there's a little box with a Q&A on it. Please click on that, put your questions in there, and we will answer those questions towards the end of the webinar. And yeah, please don't be shy to be engaging. Can we go to the next slide, please? Which will be a poll question just to understand who we're speaking with this evening. We've got essentially to find out what your objectives are for investing in the UK property market. I mean, everyone's objective is different, whether it's for passive income, wealth security, diversification, is it for succession planning? So these are very important in terms of what sort of properties you would be wanting to add to your portfolio. So yeah, building for capital appreciation, generating passive income, creating long-term investment portfolio or diversification, or immediate returns. If you can just click one of those, and we'll see what the majority of you are interested in the market for. Often I find at this stage it might come down to the age of the clients. If you're young with time on your hands, you're probably wanting to build a portfolio and asset base that, come retirement, you've built up quite a significant income stream. Whether it's an older client approaching retirement or in retirement already, that might be for passive income immediately, or it might be for someone who has the need for diversification within your market. Just seeing if this is going to come up with the results. Okay, so there we go. 68% of you are doing this or inquiring about this for generating a passive income through rental income. And then, yeah, we've got ties in terms of building capital appreciation and then long-term investment. And a few of you are looking for immediate returns. So essentially, we'll jump into the markets and what that means. But with those, I would say right up front, with property investments, if we can jump to the next slide, we're always looking at a medium to long-term approach on this. If you think you're going to become very wealthy overnight through investing in property, it's probably not the best investment for you. This is about the slow burn, what the market has done historically, and having a piece of that. It's more about being in the market for as long as possible as opposed to a quick flip. Essentially, the market in the UK, we can attest to the fact that it is the oldest property market in the world and the highest performing market in the world over its history. We are seeing property prices double between 10 and 15 years, essentially. And what has driven that growth, especially in the last 3 or 4 decades, is the fact that the UK sit in a housing crisis. There just aren't enough houses to meet the demand in the region itself. So the UK government need to bring annually close to 400,000 new residential homes to the market. The most they've delivered is about 280,000, and that was in 2021. So that problem is going to keep compounding. And until it's resolved, we've got a few decades ahead of us of a ripe market to invest in that we know there's going to be growth in. There's always going to be the need for residential homes, and in an area like the UK, on its laws, on its market, we know that it is the most stable market in the world, and is still the #1 property investment destination in the world. We might have newer markets like Dubai, Australia, the US, but essentially when it comes to historical facts, the UK has always outperformed them. Even Dubai, which will probably offer you quicker returns maybe, but just maybe not as stable. I mean, I lived in Dubai in 2008 when I saw it clear out because it's a transient community, essentially. It's not really actual home for a lot of people, whereas in the UK, it's home and no one's going anywhere. So essentially, that market has been driven by the demand. You'll see the last 2-3 years, the average property price has flattened out or tabletopped a bit. That's because we've seen a higher interest rate take place in the UK than historically, and that has seen the market slow down. However, the interest rate has started falling. It peaked at 5.5%. We are at 4.5% now, with projections to continue falling, and that is going to stimulate further sales and demand in the market. So we do know that for the next 4 to 5 years, there's a lot of positive sentiment for property growth in the UK. And just to mention, we are seeing a trend of institutional investors change from asset classes into residential property in the UK. It's actually quite incredible. as an investor, as a retail investor, you're making these decisions on your own. But if you can just follow what the banks essentially are doing, who have historically made their money off lending money to clients to buy property and charging them an interest rate. Banks like Lloyd's recently have spent over £500 million on residential property in the UK because they plan to be the biggest landlord in the UK in the next 5 years. And that just tells you they are seeing something that they want to be a part of. So it is important to follow those institutional trends, and it's something that we follow closely as a company, especially as an investment company. And we jump to the next slide, please, where we will have another poll question in terms of your biggest fear investing in the UK property market. What is that for yourself? Essentially, we're looking at, is it the potential changes in government regulations and taxes? Is it the interest rates affecting mortgage affordability? Is it the difficulty in finding suitable tenants and managing voids, or unexpected maintenance costs and repairs? So from our side, we have refined our offering to our investors. We know that over the last 20 years, we found the biggest returns and growth has been in apartments and city center living. We found that the lowest maintenance costs has been also apartments, because you've got less to manage in terms of the size of the property and whatnot. You do obviously in apartments pay service charges, which allow you the maintenance of the common area and the like, which does streamline your maintenance, so there you've got very little surprises, as such as owning a freestanding house, which might have a problem with the roof or the fence or the garden and the upkeep of a garden. So we are very conscious of our offering that we put into the market for returns. So there we go, 52% of you. The biggest fear is coming to the investing in the UK property as potential changes in government and regulations and taxes. I would say, I'll come onto that now, but interest rates affecting the mortgage affordability, difficulty finding suitable tenants coming third last, and then unexpected maintenance costs and repairs. So the potential changes in government and regulations, we are fortunate enough to have just come through a new or a recent election. A new government is placed, new bills have been passed, so we know what that looks like. Taxes themselves have changed a little bit, but gratefully they have been upfront taxes, so there are no surprises on the take home, essentially at the back end of capital gains tax, inheritance tax, or income tax. But they have increased stamp duty, or essentially transfer duties, but we know that's an upfront cost. We were also taking that into the account and the return on the investment to purchase a property and the 10-15 year investment case on that. So that is accounted for. And then interest rates affecting mortgage affordability. Sophia will go into that a bit more detail, but essentially interest rates, as I said, are dropping at the moment. They're projected to keep dropping a bit more, and Sophia will touch on the fact that you can actually fix interest rates and the like. Just before we can jump to the next slide, but on that, operating in Africa as we do with our team on the ground here, we do find that educating our audience or our clients or potentials is super paramount in the process, because actually sitting in Africa, a lot of our clientele aren't aware that from Africa you can buy or own property in the UK, and that you can actually utilize finance to do that. And being in a resident in Zimbabwe, that is something that is unusual. I know financing residential property anymore in Zimbabwe is not really a thing. It's too risky for the banks. But if you know that you can purchase a property in the UK and only put a portion of the funds into that property and have the bank pay the rest while a tenant services that mortgage for you, it is a great opportunity to build a portfolio and something significant going into the future. But just going on now with the slide on the screen, we know that I mentioned the UK residential market is hugely undersupplied. They need councils to bring 1.5 million new homes across England, and we know that that target is being so hard to be achieved at the moment. And essentially, Savills 5 year forecast indicates that despite economic conditions, property values will remain stable, and Property PLC predicts that the UK as a whole will experience compounded growth of over 12%. Now we're talking averages there. If you hone in on high performing areas, cities that are seeing regeneration and improved infrastructure and institutional investment, we can better that return if we are strategic in our approach and where we buy. Right now, if we jump into the next slide to just show the rental demand, for the first time in 10 years in the UK, it's become cheaper to actually rent than own your own house. So there's been a huge flurry to become a tenant, but there's not enough stock on the market. So essentially, the landlord sits in the pound seat there, knowing that he's always going to have a demand for their properties. So that is something to keep in mind as a landlord. And I can say also full well, knowing that being a landlord in Zimbabwe compared to in the UK is quite vastly different. You are more protected in the UK as a landlord than you would be as a landlord in Zimbabwe. So you've got the law on your side in the UK for evicting defaulting tenants or the like. There are laws in place to help assist get or solve that problem. Whereas I know in Zimbabwe it is a little bit more tricky with problem tenants. If we can jump to the next slide, please. I think as a company, we're also very specific in the type of developments we'll bring to the market, where we focus the demand for tenants. We focus on the young professional. We don't do student houses. We don't do houses of multiple occupancies, i.e. HMOs or social housing, because we want the quality of the tenant and our clients' properties to be of a high caliber to mitigate as much tenant risk as possible, and also have a tenant we know is going to be proud to live there and look after the property. Just on this slide, we're looking at UK price predictions for 2025 with the different PLCs and their projections. All of them saying that through 25 and 2026, we're going to see an increase in average property values. So we're very excited about that. As I said, the industry is very bullish of what's to come in the next 5 years. Just watching what the institutions are doing with their own diversification of their own portfolios, it's something that we can definitely get behind and be confident in saying that the next 5 years is going to be great to be a part of in the UK property sector. If we can just go to the next slide, some benefits of actually choosing UK property from Zimbabwe. We do understand that Zimbabwe, you transact in USD, which is a stable currency. I think you can get fairly decent rentals in Zimbabwe. There's no denying that. But it's what is happening on a larger scale in Zimbabwe with the housing market. What it's been quite good over the last shorter period, a few last years, but essentially what's to come, what are the tax regimes being put in place in terms of collecting rentals and whatnot. But essentially, you've got a little bit of the unknown in Zimbabwe right now with a little bit of unrest or murmurs of coups last week and whatnot. So you do essentially, even though you might have a good cash flow in Zimbabwe, just diversify a little bit. Just take a little bit of what you got there if you are in that market and it's going well, and just secure some of that wealth to a market that is just a little bit more, or I should say a lot more consistent, with quite a more clearer outrun in terms of what the future looks like for the market. So if it comes down to, if it's just for diversification, if you're just mitigating your exposure to the Zimbabwe economy, I know there's rumors or talk of having the ZiG being the operating currency by 2030. If we can get past this year, even with that, it'll be amazing, I know. But it is just, you got to be in tune with what is happening in your current market to kind of make educated decisions, and just like I say, just have a portion of diversification for yourself, which falls into the legacy side of things. And I would say most of our clients that purchase property from us, who want to build portfolios, they want to hand this over to the next generation, to their kids, to their grandkids. So even though they will derive a lot of value out of the capital appreciation of these properties, they will eventually be paid off and earning them a passive income and essentially an asset in a strong economy, strong currency that you can access finance or get equity out of for whatever other projects or building the portfolio. But to hand a asset over like a UK property to the next generation is probably one of the best gifts you can leave behind because of the tools available still to be utilized on that. Accessing leverage, as I mentioned already, and Sophia will go through it, having the opportunity to only put a minority portion of the funds of a property into it while you benefit from the full capital appreciation of that property, and you've got a tenant in there that is paying off the holding fees of that property. It's a fantastic model. And we must liken it to the fact of leverage in the stock markets or equities and whatnot, which is incredibly risky and volatile. Leverage in the property sector is completely different because of its non-volatility, its stable asset class that it is. You know you can leverage with peace of mind. You know the banks that are lending you the money are doing their due diligence and are backing the rise in the industry and the asset class. So you can sleep easy at night saying you're not taking on a lot of risk with leverage. Sophia will get more into that. But as African citizens, we know that we've got an extra channel of income from investing in the UK market. Not only is it capital appreciation and then the rental income, but we are also getting a currency hedge. I know, as I mentioned, you do operate in USD, and that for now is a stable currency. There's obviously a lot of stuff happening in the US, which is another thing to take into consideration. But essentially, other African countries do benefit as well from the currency exchange benefits when their currencies take a bit of a knock, or the pound does quite well. There are tax treaties that we like to inform our clients about, especially as Zimbabweans. We know that Zimbabwe and the UK has a dual tax allowance for landlords there, which means you get tax alleviation for income generated out of rentals. That's something our clients take advantage of. So you'll get up to £12,570 a year that you don't have to pay tax in the UK on. And if you do a joint purchase with your spouse, you're getting up to over £25,000 alleviation. So it's a huge benefit for that. Then there are also non-resident land tax or non-resident tax advantages, like setting up UK limited companies, which we would assist in and help you with that, which have a whole other plethora of advantages you can take advantage of. We can talk you through those strategies on a one-on-one should you wish. But just at this point, I'd like to introduce you, or I'll bring Sophia on, but we'll go into a poll question first. But Sophia, if you wouldn't mind joining us, thank you for joining us this evening. Sophia is the director and founder of Maidwell Group, one of our partners with our partners with helping our clients access financing to purchase property in the UK. Thank you, Sophia.
Thank you, Mark. And thanks for having me. And thank you, all of you, for joining us this evening. So as Mark has now gone into quite an in-depth summary, if you were, of the UK property market and why the UK is such an attractive market for our clients, particularly from Zimbabwe, I'm now going to walk you through what your financing options look like and what the mortgage journey looks like for yourselves as residents from Zimbabwe. So if we jump into the first slide, please. So we'll start off with a poll question. And if you could select one from the 4 drop-downs, what do you think is the biggest challenge in getting a mortgage as an overseas investor? Would you say A, lack of credit history in the UK, opening a UK bank account, limited lender options, or complicated application process? We'll allow you a couple of minutes just to complete your selection. All right, then. Okay, so the majority of you have voted for lack of credit history in the UK as the most common or biggest challenge you feel as investors overseas. And the short answer is you don't have to have any UK credit footprint in the UK. In fact, you don't need to travel to the UK at all throughout the whole mortgage process and even beyond. We can do it all remotely from wherever you are based across the globe. And that's the beauty of working with us. We manage that whole process for you so that you don't have to. Sometimes some banks might ask for a credit report from where you reside locally. So if they may ask for a Zimbabwe credit report or wherever you are across the globe. However, often that isn't the requirement. They will look at your income. If you are salaried, then they'll want to see proof of that. If not, we'll base it solely on the rent of the property. But ultimately, there is no credit requirement in the UK in order to acquire a mortgage in the UK. Opening a UK bank account. Sometimes that is a requirement. If it is, we will assist you with that. We will manage that whole process for you. We will make the relevant introductions to the banks, all the lenders, all the kind of institutions that will assist you in setting up that UK bank account. And that will be the account that will collect your rent as well as service your monthly mortgage repayments. On the flip side of that, though, it's important to note that we often have clients who sometimes prefer to make their mortgage repayments or collect rent in an overseas bank account, so not an account in the UK, in which case, if that is your preference, there are also lenders out there who will accept the repayments being made from an account in Zimbabwe or in the US, as an example. So there is a lot of flexibility around that. Limited lender options. It's an interesting one. We do often get that concern, if you were. Yes, there are fewer lenders, if you were, but more importantly, that it's specialist lenders we would be approaching for clients in Zimbabwe, as an example. We wouldn't be approaching, the high street banks like Lloyd's and Halifax, because of course you're based overseas, and as such, we approach the specialist lenders that are able to look at yourselves as overseas borrowers, first-time investors, first-time landlords potentially, and first-time buyers. But there are certainly an array of lenders. And as we'll look at in the case studies later on, there are lenders that are willing to go up to quite competitive loan to values as well, with you reducing or limiting your loan to value at the outset. So there are certainly lenders available. We're very familiar with the lenders that have an appetite to lend to Zimbabwe clients, but also we're very familiar with their process and their criteria. So again, by working with us and having us manage that application process for you, just avoid any challenges, which also leads us on to the next point, which is complicated application process. We're very, like I said, we work very closely with these underwriters, with the bankers, and we know what they like to see and how they like an application to be packaged, and that ultimately can alleviate a lot of the challenges and avoid any unnecessary complications. So those things can quite simply be alleviated just by starting the process early, having those conversations with us, and we will then take it from there. Next slide, please. So jumping into a couple more frequently asked questions, the first one being, how much can I borrow? Now, there are a lot of factors which determine how much you can borrow. It comes down to where are your funds derived from? Are you self-employed? Are you employed? Do you already own a property in the UK, or do you already own a rental property in Zimbabwe? All of these factors play a role, but ultimately there are lenders that, on average, we say for Zimbabwe borrowers, you're looking at anywhere between 65%. There are lenders that will sometimes go to 70 and maybe 75%. We always say, look, budget for around the 65% mark for the rates to remain competitive as well. Can I mortgage multiple investment properties from Zimbabwe? Absolutely. If you're potentially looking at purchasing multiple properties under one company or multiple properties in one go, we will look at that as a group, if you were, as a combined mortgage application, and we will then go and approach specific lenders that have an appetite to offer you potentially one facility, so one mortgage against the portfolio, as opposed to doing multiple applications. But it also depends on when the properties are completing, and then we can time it accordingly. But in short, absolutely, if you're looking at doing multiple properties and multiple investment properties, then we can certainly look at bulking that into one loan. Can I get a mortgage if I do not have an income? Yes, absolutely. As we sort of touched on earlier, there are lenders that take several different approaches. Some will look at a combination of what you earn and what the property is going to generate, because of course the important thing to factor here is the property is going to be generating a passive rental income. So ultimately, if you don't earn an income or it's quite challenging to demonstrate, then we can look at lenders that will base the affordability and the mortgage solely on what the property is going to generate on a monthly basis from the rent. From there, they'll be able to then decipher how much they're willing to lend you, and then we can then proceed from there with a full mortgage application. So there are several different ways. I recently had a client as an example who was retired, did not have a fixed income at all, and we based their mortgage solely on the rent the property was going to be generating, and we were able to get their 70% loan to value mortgage. So there are certainly options out there. And finally, what are the benefits of speaking to a mortgage broker? I think what we've spoken about up to now sort of summarized it all, but in short, really, it just by working with us and having those conversations with us, alleviates all those unnecessary challenges and complications that can be avoided. Like I said, we work very closely with the bankers, the underwriters, and all of the other sort of ancillary services and that come with arranging a mortgage and purchasing a property in the UK. So liaising with the solicitors, the valuers, and so on. So we will be your point of contact for everything else. So by working with us, we're able to manage all the other parties involved in the process. And also the other thing to point out, I think, is, as Mark touched on, interest rates in the UK, if we focus there, have gone down in the last few months. They peaked at 5.1% last year with the Bank of England base rate. The base rate is now at 4.5%, and that is expected to continue to go down over the next couple of years. So with that, we're seeing a lot of lenders change their rates quite quickly. Sometimes they give us 24 hours notice and they say that you need to submit an application because this product is going to be, pulled. So by working with us directly, we're able to ensure that those applications are submitted in a timely manner to ensure that that product that you want is locked in. And then from there, we can manage that whole process and application for you up to successful completion and beyond. But I think those are really the huge benefits, especially in the economic climate that we're going through at the moment, where rates are changing and new products are coming to the market, lenders are adjusting their pricing. You want to work with a team that ultimately can ensure that your mortgage application is submitted on time and also is successfully approved as well. Next slide, please. So just going into now the different types of mortgages in the UK. Firstly, we'll start off with different rates. So we've spoken about the market and where the UK interest rates are expected to continue to go. So with that, as a borrower, you can opt for two different types of rates mainly: fixed rate mortgages and variable rate mortgages. Ultimately, this just comes down to your appetite to risk. And fixed rate mortgages are essentially a rate which is fixed for an agreed period of time, normally between 2 to 5 years. And that means that you agree with the lender that for that period of time, your monthly mortgage repayments are going to remain the same. So regardless of what happens in the markets, your monthly mortgage repayments are going to remain the same for that set period of time. So this really allows you to budget accordingly. And sometimes as an overseas investor, a lot of our clients prefer to fix their rates, knowing that they can budget accordingly, and they know what their rent is going to be, and ultimately they know what their surplus is going to be every month. So it allows you just that comfort as an overseas borrower. Alternatively, you also have variable rate mortgages in the UK, and those might be rates that follow, as an example, the Bank of England base rate directly. So as the Bank of England base rate goes down, your interest rate goes down, and ultimately your monthly mortgage repayments will go down. The other benefit of variable rate mortgages is that sometimes they do have lower early redemption penalties, if any at all. And that essentially means that should you wish to pay off the mortgage early, or just maybe not the whole amount, but a lump sum of it, you can often do so with a variable rate mortgage at less penalties than as opposed to on a fixed rate mortgage. But ultimately, it just comes down to preference. There are a range of different options. And then when we do go into having our conversations and exploring those options for you, we could present you with both options, and then make a time when we make a decision as when we come to submitting the mortgage application. Next slide, please. So looking at the different repayment structures in the UK as well, there are two main options: capital repayment mortgages and interest-only mortgages. So starting off with a capital payment mortgage is probably one that many of you are familiar with. It's a mortgage whereby every month you are paying down the loan amount and you are paying down the interest. So that means at the end of the mortgage term, let's assume you go for a 25-year mortgage, At the end of that term, your mortgage is fully repaid and you don't owe anything more to the bank. Alternatively, in the UK, you have what's known as an interest-only mortgage, and this is quite a niche product that the UK offers, and there are only a handful of markets across the globe that offer it. And it's essentially a mortgage where you're paying just the interest on the loan amount. So the loan amount itself, the balance is not reducing, you are just servicing the interest on a monthly basis. So what that means as a result is that your monthly repayments are of course lower because you're only paying the interest now, not the interest and the loan amount. So your monthly payments are lower, your cash flow as a result is higher, and that enables you to then grow your property portfolio a lot quicker. So if this is an investment property, like I assume many of you this evening are looking at, it's a buy-to-let property, you're looking at growing a property portfolio, perhaps having a few properties in the UK, generating your passive rental income, then by going for an interest-only mortgage, it enables you to do so and grow your property portfolio a lot quicker. Of course, at the end of the mortgage term, you do need to find a way to repay back the lender, the loan amount, because of course you've not been reducing the loan amount. And that can normally be done through mainly three ways. Either remortgaging, which is the most common route typically, and that's when every couple of years, every 2 to 5 years, we'll negotiate new terms, either with the same lender or with a new lender, but we'll negotiate new terms at a more competitive rate. At that point, lender A is repaid and lender B then takes over the new mortgage. So that's one option. Option two is if you have other assets or other investments, let's say you have another property in the background or you have a substantial amount of savings, you can pay it off through that. Or of course, you can pay it off through selling the property. The property, let's say you buy the property for £300,000, then 10 years later, you sell it for £600,000. You can repay back the lender what you borrowed at the beginning of the mortgage 10 years ago, take your profit and then reinvest that into a new mortgage or into a new property, sorry. But that is typically what investors will do. They'll go for an interest-only mortgage, ultimately to increase their cash flow, enabling them to diversify and grow their property portfolio a lot quicker. Next slide, please. So now just going into, we've looked at the different mortgage options in summary, going into now the different, the benefits of investing with a mortgage, because we often have clients who come to us and either, as you've seen from the poll answers, aren't aware that they're able to get a mortgage as overseas investors without a UK credit footprint, and also perhaps aren't aware of the benefits of taking out a mortgage and how you could take advantage of leveraging and growing a property portfolio in the UK. So this example just really summarizes it for you. It doesn't take into consideration rental income and interest rates, do bear that in mind, but it's just a very simplified example of what are the benefits of mortgage versus purchasing in cash. So if we look at the first line, this is assuming one were to purchase a property in cash for £200,000. Now let's say you hold on to that property for 10 years and 10 years later you sell it for £300,000. Your investment was £200,000. Your profit was £100,000, which equates to a 50% profit on your initial investment. Now, if we use that same property, and let's say that borrower, as opposed to purchasing that property in cash, decided they took to take out a mortgage, and they took out a 75% loan-to-value mortgage. So they put down a deposit of £50,000, and they borrowed £150,000 from the bank. 10 years later, again, you sell that property for £300,000. Your investment was only £50,000 because that was the deposit that you put down. Your profit is then £100,000. However, that equates to a 200% profit on your initial investment, which is the £50,000 you put down 10 years ago. And then when you see how this really works well, and the beauty of mortgages and leveraging is, if we look at the next slide, please, you'll see that as opposed to putting £200,000 into one property, you could spread that across 4 properties, generating a total asset or portfolio value of £800,000. You borrow £600,000 from the bank. 10 years later, you then sell each of those properties for £300,000. Your investment was £200,000 10 years ago. Same as in the first example on the top, if you were to purchase one in cash, but now with £200,000, you've bought 4 properties. Your profit is then £400,000, which equates to a 200% profit on your initial investment. The other thing to bear in mind is we spoke about remortgaging in the previous slide. As opposed to selling those properties, what investors tend to do, in fact, is refinance. So that additional £100,000 equity in those properties that has built up over the last 10 years, you could then look at capital raising, taking some of that additional equity out and then reinvesting that into another property. And then very quickly, those 4 properties that you initially buy can then become 6, 8, 10, and so on. Ultimately, then growing your property portfolio, generating you a passive rental income. And then when you couple that with an interest-only mortgage as well, it just ensures that your cash flow is as high as possible. And it's a really beautiful model. It's a really great tool. And it's the most common structure. I would say that's what 90% of our clients, whether it's UK based or overseas, that's what 90% of our clients go for. Next slide, please. So we've put together a very brief cash flow for you. Mark and his team will go into a far more in-depth one based on the unit that you select, and then based on our conversations, what mortgage you are able to obtain. But we've put together a very simplified cash flow for you based on a client of ours who is a resident in Zimbabwe. They were purchasing a property in the settled development that we were working on at the back end of last year, which was a very successful project that we were working on. So we thought we'd summarize this for you just to show you what these terms looked like. So starting at the top, this unit was being purchased for £355,000. It was a 2-bedroom apartment, and this borrower in particular wanted to put down a 40% deposit, which means that they borrowed 60% from the bank. It was known as a 60% loan to value mortgage. They went for an interest-only mortgage, and that equated to a loan amount of £213,000. Now, as of today, this rate is a variable rate. So this borrower wanted to go for a rate which follows the market. It moves in line with the market. So as the rates go down, their rate will go down with that. So this followed the SONIA benchmark. As of today, the rate is all in at 7.06%. However, bear in mind, as we said, as SONIA goes down, this rate will go down with it. It's broken down as 2.6%, which is the fixed portion of it, plus SONIA. So whatever SONIA is, will be then the total rate payable. The term is 10 years. There are options, bear in mind, to go for up to a 25-year mortgage, but bear in mind, as it's interest only, that has no bearing on the loan, on the monthly mortgage repayment. So it's a 10-year term in this case, and that made the monthly repayments £1,253. So if we look at now the column on the right-hand side, let's look at the rent the property is going to generate on a monthly basis. That's £1,775 a month, which equates to £21,300 a year. When we take off the monthly mortgage repayments, the service charges, letting and management fees, and all those costs associated, this borrower is left with £195 net a month, which equates to £2,340 a year. Now, bear in mind, every year that rent is going to go up. So we're starting off at £1,775 in year 1, in year 2, in year 3, and so on. That rent is going to go up. You're going to agree a higher rental amount with your tenants every year. So you've got the benefit of your monthly income increasing. Rates are expected to go down, so that makes your monthly mortgage repayments reduce, so increasing your surplus every month. So you have the benefit of that. But the other benefit is, of course, you have the benefit of the capital appreciation property, because this isn't just a short-term investment. This is something that you're looking at holding on to for 10, 15 years or so. At that point, the property is expected to almost double, if not in value. At that point, we can then look at refinancing, releasing the additional equity that's built up in that property, and then reinvesting that into another investment property. Again, the same model, generating your passive rental income with the mortgage looking after itself, and again, leaving you with a healthy surplus income. So that's a very summarized, as we said, cash flow, but hopefully it gives you a good indication as to how the mortgage would work and what the investment would look like for you. We just go on to the next slide, please. And finally, we put together just a very summarized checklist for you. Again, everyone's circumstances will be different. So dependent on the bank that we approach, dependent on your financial profile, will determine what documents are required. But to begin with, we thought we'd leave you with something this evening, just so you can go away and think about what documents you would need when we come to starting the process. So the first piece of information, and probably one of the most important, is identification. So we would need a copy of your passport and your proof of address. We will then, of course, need details on the property, which we will obtain from Mark and his team, because ultimately, how much the property is going to rent It's probably one of the most important factors because that determines how much the bank is willing to lend us. From there, we will then decipher what deposit you need, how much you need to put down, and also the timeframes as to when you need those deposit amounts ready for. We'll look at your financial strength. So we'll look at income. Are you self-employed? Are you employed? If you're self-employed, if you have tax returns, then we'll provide those to the bank. If not, then we won't. Then we'll just approach a lender who doesn't require those. Again, if you're employed, then we'll need pay slips. As I touched on at the beginning, we may need a credit report, but overall, we just need to have an understanding as to financial strength and also your source of wealth. So to understand where the deposit is coming from, so we can build the narrative for the underwriters. UK bank account. So if you need a UK bank account for the mortgage, we'll arrange that for you. If not, we can arrange that from another overseas bank account, or you can use the accounts that you have already set up. And finally, legal and regulatory compliance. So although we can't advise on the taxes in the UK, it's always recommended to have a conversation with those professionals, and Mark can introduce you to firms that, trusted firms that we've built relationships with over a number of years. But having those conversations with the professionals to ensure that you are structuring the purchase in a way that makes the most financial strength for you. The beauty of the UK is there are so many ways in which you can structure the purchase. You can buy a property in a company as opposed to in your personal name, as an example. By having those conversations and knowing how best to structure it enables you to essentially set up the property and set up the purchase in a way that makes the most financial strength for you, sense for you, and ultimately is going to be set up in the most efficient manner. So I think that's everything for me. If we jump onto the next slide, please, I'm going to pass back over to Mark, who is now going to walk you through some of the properties that we're showcasing this evening and how you can go about selecting your investment property. So over to you, Mark.
Thanks, Sophia. I appreciate that. Just to bed down a little bit in terms of the financial strength and legal and regulatory compliance for Zimbabweans, we do understand it's mostly a cash society. So there are obviously ways around that we need to be focused on. And when it comes to a cash purchase or deposit, it is important to have the source of that cash or the wealth. So whether it be a sale of an asset, having the invoice for that, if it was a sale of a property, making sure that the correct solicitors were involved in that sale and where the funds came from, pay slips, or another alternative one that Sophia suggested were tax returns showing that you've submitted tax on the income. But there are ways around it, just to mention that. But in terms of choosing the right property on the right location, how do we do that? And essentially, this is why you would partner with a firm like ours. It's one of our strengths in what we do. We also help advise some of the developers we work with on how to do this. And it's quite a simple formula, really. Anywhere in the world, you're not going to go buy a property in the middle of nowhere and hope for massive appreciation and rental income. You need to have the fundamentals in place. Is it easy to get to? Are there future developments taking place? What regeneration and local economic factors are taking place? Are institutions investing there and operating there, meaning that there are jobs on the market, which means if there are jobs, there are employees, there's a rental market to supply to. So these key fundamentals aren't really that difficult, but if you start digging away at the surface and seeing the scale of these factors in an area, you can start uncovering high performance areas quite quickly. And I'll show you this right now on the next slide. If you speak to anyone that's not too well versed in the UK property market right now, and you speak about property investment in the UK, they're automatically going to think London, because London has outperformed most markets in the last few decades. It's done incredibly well. It is a very stable market, but my word, is it expensive now. We're looking at an average property price of about £673,000. Some say it's over £700,000 at the moment, but that is a big barrier to entry. The forecast growth currently for the UK is in the next 5 years it's below 10%. And we're seeing average rental yields of about 3.82%. So that's below 4%. Whereas us as a company sold our last property in London maybe 2-3 years ago, and we are focused heavily on the regional cities. If we bring up the next slide, you'll see why. In terms of barrier to entries in these cities being Birmingham, £228,000, Derby, it's actually a little bit more than £200,000. Leeds, 234. Manchester, 284. Actually, Manchester's above £300,000 on the latest data I've seen. So essentially, these cities offer a lower barrier to entry, but look at the average rental returns, above 6% in most of them. And then the 5-year price prediction being around the 20s, between 20 and 28%. So as an investor, you're going to have a better cash flow, and in the medium to long term, you're going to see a lot more growth in your asset than if you were in an expensive location like London. So if we go to the next slide, you can do a simple SWOT analysis on these prices versus capital appreciation and rental incomes, and it's quite easily achievable to see what areas you should be focusing on as an investor. So tonight I want to bring our attention to our latest launch that we as a company have launched in the last week or so in Derby. Derby, if we go to the next slide, is the most central city in the UK. It's not a very big city, but man, they've got a lot going on for them, a lot of activity, a hub of essentially exactly what we spoke about: regeneration, infrastructure improvement, lots of institutions investing there and the like. So if we jump to the next slide, we'll see that the average property price in Derby is at about £212,000. We averaging about £813 monthly rental. I think from a personal point of view, in my career, I've actually sold a lot of property in Derby. And why I love it, and I've got an affinity to it, is that all those properties have outperformed our projections for our clients. So I've got many happy clients that own assets and properties in Derby that have benefited from the uplift in value, and also the type of development we've sold them that has done well in the market. If we jump to the next slide, we'll talk on to the fact that it's been named one of the best places to buy property in the UK because of these fundamental factors. So this evening, I want to invite a colleague of mine or ours onto the webinar to help explain just a little bit about the rental market in Derby. She is a rental and letting specialist, but she also happens to be our regional accounts manager for Africa. So if Gillian can join us just to take us through the intricacies of the current Derby rental market at the moment. Let's see if...
Hi, everybody. Thank you, Mark, and everyone. Great to be on the webinar and talking with you today. My name is Gillian, and I'm the Regional Account Manager for Africa. I have 10 years experience, most recently in the build-to-rent sector, working with institutional landlords prior to joining Joseph Mews. So I'm going to take you through some key rental insights in Derby. So as you can see, as of February 2025, the average rents in Derby are up 11.9% year on year, with one-bedroom rents surging 12.8%, which is well above the East Midlands average of 8.3% and the UK average of 9%. This is largely due to the lack of supply and the demand for good quality housing in the region, as well as population constraints, the growing population in Derby. So with yields reaching up to nearly 8.6%, Derby ranks among the top UK cities for returns, where the average compared to the average UK rental yield, which is around 6%. So a shortage of rental stock is largely due to Derby's rising population, but that's driven by a youthful population, with 50% being under 35 and 30,000 students driving a strong economic output. The above These types of tenants and this demographic and population require an incredibly well-connected city, which Derby has to offer and which tenants value, especially those without vehicles, again, meaning high demand and over 15 applicants per property on average in Derby. So I wanted to talk, Mark has spoken a lot about institutional landlords, and I just wanted to give you a bit of an insight into what's happening in the background with companies such as Granger PLC and St. James Securities. So among a lot of other institutional landlords, these are playing a major role in reshaping the UK rental landscape, as well as the rental landscape in Derby. So these large organizations manage vast property portfolios and are focused on long-term stable returns. And they're all capitalizing on the lack of supply in the market. So to give you an insight on the caliber of these institutional landlords, Granger PLC is the UK's largest listed residential landlord with FTSE 250 status, and they manage over 9,000 homes. They have invested £37 million into Derby alone as part of its £9 billion portfolio. Another example, St. James Securities have over £1 billion in completed projects and spearheading a £230 million regeneration of Derby's Maidwell area. So their involvement alongside that of other major players, for example, many of you would have heard of Legal & General, AXA and BlackRock, signal a strong vote of confidence in the UK rental market and highlights Derby's emergence as a key investment hotspot. And slide 3. So in my lettings experience, we often have clients express that tenant suitability is a main concern for them, and rightfully so. Each landlord wants to make sure that they have a good quality tenant that pays rent on time, and each tenant wants a decent home to live in. So just to touch on the referencing process and how, as a landlord, you are protected from that, each tenant will have to go through a stringent employment check or referencing checks. These are usually a 4-point check. So the tenant must earn 30 times the monthly rent annually. And if they cannot, if that is not to be proven, then they would have to prepay 6 months rent in advance. And the referencing company and the managing agent will directly reach out to the employer, so those risks can be mitigated. Identity check will also be conducted. This verifies the tenant's right to rent and remain in the UK. A credit check will also be done. This flags any unpaid debts, as well as checks for any potential, for example, county court judgments, just to make sure that the tenant is tangible. And a previous landlord reference. And with a previous landlord reference, this confirms a good rental history from the tenant. And if any steps fail, the landlord has the choice to reject the renter. The previous landlord check will also be done to check that the tenant has always paid their rent on time. And why, as a landlord, why new builds make life easier for yourself? So there's minimal maintenance, there's no rewiring, no boiler issues, no legacy issues. They're fully compliant with current energy efficiency and safety standards. And of course, it attracts quality tenants who want a modern, hassle-free rent experience. Thank you. I'm now going to hand over to my colleague, Mark.
Thanks, Gillian. I really appreciate those insights. I must just say that Gillian, coming from that side of the industry, is very beneficial for our clients. As a team, we work very closely together in holding your hand through building the confidence in the product that we do offer to our clients. And yeah, thanks, Gillian. That insight is insurmountable. Just to go on to our new launch, like we obviously do have a number of projects on offer, but it's very seldom that we launch a new launch from the beginning, and we've got the opportunity tonight to enjoy this. The early bird always gets the worm, so make advantage of that. We do have an incentive for all of you that are registered for this webinar, so should you choose to proceed in this project in the next week, we'll give you a bit of an incentive on the purchase. But essentially what we're looking at is, if we can go to the next slide, please, and probably the next slide after that, is Loom House in Derby City Centre. So it is essentially the third phase of a 3-phase build. It is phase 1 and 2 are completed and already, if we go to the next slide, are performing above what was initially projected for us. We are starting off studio apartment units at £148,000. 1-bedroom units are from £180,000, and 2-bedroom units are from £250,000 essentially. We are projecting yields between 6 and 7% for these units, and that's going off genuine information from phase 1 and 2 already. And I think the beauty of this one for me is it's the most central development that we've actually offered in Derby in our history. And it is off plan, obviously, and due to complete in Q1 2026. However, we are about just over a month ahead of build schedule. So even if the project does complete at this side of the year, you are able to complete next year. But what that means, and what I should have mentioned in one of the slides about investing from Zimbabwe, we know we've got a $50,000 allowance to take out of Zimbabwe as an individual. So a lot of our clients out of Zimbabwe do favor the off-plan purchase model because it allows them to manage your cash flow. You can, as an individual, take the £50,000 out this side of the year and pay your 20% deposit, or if you are doing a joint purchase with your spouse, you can take £100,000. But because the project completes next year, the completion balance will be due next year, and that allowance resets for you. So essentially, you can take another £50,000 per individual out next year. So it does help manage that cash flow. It allows you to also save towards the completion balance while you benefit from the growth of the property while the build takes place. If we jump to the next slide, I can illustrate to you the exact location of Loom House. If you see where my cursor is, Loom House sits in the very center of the city, which is across the road from the Derby and Shopping Mall, which is a fairly new shopping mall that completed in the last 2 to 3 years. It is an incredible retail and entertainment space. Obviously, dining and amenities such as gyms and whatnot. And then essentially 100 meters down the road, you've got the main train station for Derby. So that makes access to Derby very easy. It is only 30 minutes away from Birmingham city centre and just over an hour and a half or hour 40 from London. So the accessibility for this particular block is incredible. As we mentioned, the institutions that are based there, Rolls-Royce Aviation and Toyota and the likes, they all have shuttles for their employees buzzing around the city that collects them in the morning, drops them off in the afternoon. So the employers are very employee focused in Derby, and that does make it one of the most appealing cities to live in, especially the fact that it's got the 7th highest grad wage in the UK. So a lot of graduates flock to Derby to obviously get their work experience and achieve a better wage than most places in the UK. If we go to the next slides, we'll just show you illustrations of the block. Essentially, it's 111 units in Loom House. Next slide, please. We are looking at the interior of the completed block 1 and 2. These are the specs that we've delivered, essentially very high spec, focusing on that high LSM tenant as we spoke about, making sure that the right tenant comes to live there. If we go to the bedroom, the next slide, you'll see the quality continues from there. And the next slide, another example of a living room, and we can go on to the bathroom. Now, essentially, this development was developed by Elevate Property Group. Elevate Property Group are one of the biggest independent developers in Birmingham and the West Midlands. They have brought a number of projects to the market which have been award-winning. They've got a very particular style in terms of the luxury finishes that they will include and creating that tenant demand. And that is exactly what a landlord wants. But just crushing the numbers quickly to understand what you need to be able to consider a development like this for yourself. If we can jump to the next slide, we'll start on an entry-level studio apartment in Loom House at £148,000. What the process looks like is if you've identified a unit that you like and it's still available, you can reserve it by paying a £2,500 reservation fee, which would be an immediate transaction. That will take the unit off the availability so that our agents and our network globally don't sell that for you. Then we'll introduce you to the solicitors. You'll engage with them and start the exchange process in terms of collating your source of funds, anti-money laundering, and going through the sales agreement for yourself and understanding anything on the property that you need to know. We work towards an exchange period of 28 days to get this done. On that 28 days or on exchange, you're expected to pay 20% deposit, excluding the reservation fee you've already paid that contributes to the deposit. But on the deposit being paid and the exchange of contracts taking place, that property is now yours. The developer is unable to sell that to anyone on the market, even if the market goes through the roof with prices. you have locked in at that price. And essentially, you are obligated to follow through with the purchase with the developer on completion. So what the completion looks like for Q1 next year is when the remainder balance, the 80% is due. And in this case, £118,400 is due, but that will be comprised, if you're utilizing a mortgage, that will be, and let's use a 65% mortgage as an example, because that is what we are seeing with our clients out of Zimbabwe currently. That will mean that you'll need to pay an extra 15% of the property value next year, which ends up being about £22,200. But there are fees included, as Zimbabwe has transfer fees, the UK has stamp duty, land tax, so the stamp duty and mortgage broker fees, that will amount to about £14,000 on this particular purchase. Rule of thumb, if you're using a mortgage, the cost of the sale is about 10%. But that looks like for yourselves over a time period between now and next year when it completes, a total of £65,800 in. So entry level right now would be to have just under £30,000 worth of liquid cash to deposit and exchange on the property, and then the remainder amount being an extra £36,200 next year. So that's what we're looking at for entry level of the development. If you want to look at a one bedroom, if we flip to the next slide quickly, we'll see that, and that being £180,000 starting for a one bedroom. We are waiting for the next slide to pop up. Should be coming now, hopefully. I think this slide is frozen. But we'll leave it that currently in terms of your entry level. We can speak to you further on that one bedroom or two bedroom should you look at that. Oh, here it comes now, 180,000, same £2,500 reservation fee. You're looking at a deposit amount of another £33,500. And then next year you're looking to complete with fees and everything at about £45,000. So it's broken up at £36,000 including solicitors' fees this year, and then £45,000 next year. So in total, you are spending £81,000 to purchase a property valued at £180,000. So if we jump to the next slide, just briefly, we do have other offerings in Birmingham, in Manchester, in Leeds. We got a fantastic development in Leeds now, which is something so unique that we've first time offering something of that stature. So we do have other offerings to chat about if that you do have a preference elsewhere or want to explore those options. It's not limited to Loom House, but obviously very excited about the launch. And then if we jump to the next slide, if you do reserve one of these properties within the next week, we'll contribute £1,000 towards your legal fees, which obviously every pound counts towards the end goal. And then just on the next one, I think we're going to bring up next steps in terms of should you want to book a meeting. We got our full team available to you. So myself, Bevan, Fulian, our account manager, sales manager, Gillian, our account manager, and Sophia, if you want to speak about mortgages, just indicate on the poll if you want to book in a meeting with one of us, and we can take you through that and make ourselves available to guide you in the process and chat a little bit further around it. Right now, we do have a number of questions that have come through. I'm conscious of time, so we'll go through these questions, and Sophia and myself can answer them, or Gillian if there's anything on rentals. But Sophia, if you wouldn't mind joining me again, and we can go into a little bit of the Q&As here. So the first one will be, will this meeting recording be available to us after the call? Yes, we'll send you the recording, so you'll go through that. Can I qualify for a mortgage when I am from Zimbabwe and receive income in South Africa? Sophia, I'll allow you to answer that one.
Yes, absolutely. We do. We actually see that quite a lot. In fact, we're completing on a mortgage next Friday, actually, for two clients who bought 4 units, and they are Zimbabwe based, but their income is all generated in South Africa. And yes, absolutely. And they've secured a 65% loan to value mortgage. There are options to potentially go higher as well, but that's what they've locked in. So yes, in short, absolutely. We just need to evidence where the income is coming from and those bank statements to demonstrate that income being credited to those accounts.
Okay, thank you. With regards to using a Zimbabwean credit history to qualify for credit, what happens when I get paid in cash in Zimbabwe because of the ZIG situation? And how will you track my credit history?
So it's an interesting one, because we often, when we do carry out our initial fact finds, one of the first questions we ask, particularly for our clients in Zimbabwe, is, are you paid in cash, or is your salary credited? And then from there, we can then decipher which lenders we will approach. If you are paid in cash predominantly, then we'll approach certain lenders. And if your salary is credited to a bank account, and perhaps there's a credit report which can pick up on a footprint for you, then we will go down a different route. But ultimately, there are lenders that will do either. So that wouldn't be a hindrance in itself at all.
Okay, brilliant. And then I don't have funds, but I'm employed in Europe, Lithuania. Can I borrow basing on my salary from my company?
Yes, of course. So we can look at a combination of the salary that you are receiving from your job, whether it be in Lithuania or anywhere else. We will need to potentially see pay slips and bank statements from Lithuania showing the salary coming in. And then, of course, we'll take the details on the property itself, what the property is going to generate on a monthly basis. And yeah, based on that, we can then obtain a mortgage for you.
Okay, brilliant. And then I'm assuming this would be someone else has asked also. I am a Zimbabwean in Lithuania, but need to invest in UK property. The challenge is that UK no longer recognizes the EU, or no longer in the EU, and my visa doesn't allow me to visit the UK to view my properties. How is this dealt with? Now, essentially, it's important to understand that the property purchase in the UK doesn't allow you residency, and it doesn't give you visa favors or whatnot. It doesn't attribute to an easier visa. However, I've never had a problem with any of my clients wanting to go view their properties. We also, as a company, will invite you to come and view your investment through us. So it does assist in the visa application as a tourist to come and visit, but there are no residential or visa benefits of owning a property there. And I would say 85% of my clients probably have never seen their properties, never visited them. They obviously are there for them to go visit if they ever do, and we'll arrange that. But essentially, most of these decisions are made on the fact that the investment is there for a tenant to be in there and to earn an income and appreciate in value. So we do urge our clients to detach the emotional side of purchasing the property, what it looks like or what your preference is, what you would live in normally, and just focus on what the market needs in the UK. So we'll happily arrange viewings and whatnot of the properties, but essentially not always essential to see the performance of the property, right? So yeah, I'll leave that there. I don't think so. There's another one, does owning a property in the UK help with visas? So I've just answered that. Someone's asking to book a meeting. Not a problem. Am I able to get financing facility to raise the deposit required and then repay the loan and the mortgage simultaneously? Unfortunately, I can answer this right now. Your minimum requirement would need to be, as that studio apartment example, just under 40,000, sorry, just under 30,000 pounds liquid cash. You need to make that deposit yourself, your own equity into that deposit. So that would be the minimum requirement, and moving ahead with the meeting or wanting to actually explore the option. And another one, can I leverage my property in Zimbabwe to secure a property in the UK? Sophia, you can answer that one.
If your bank locally, or you have a lender that's able to take a security against your property in Zimbabwe and do a capital raise or an equity release against your property in Zimbabwe, then absolutely, yeah. It's challenging for UK lenders to take a security against the property in Zimbabwe, but certainly if you have an option to take out debt from your existing property in Zimbabwe, then yes, the banks in the UK will then accept that as your source of deposit.
Okay, brilliant. And then,
Are these mortgages insured in the event of my death? What happens then? So we normally recommend, it's not a legal requirement, but we normally recommend taking out some sort of insurance policy alongside, and that will obviously protect you in the event of death. You know, the mortgage is still going to be looked after, and it can be serviced. But that isn't illegal. That isn't necessarily a legal requirement. It's just, you know, it's a recommendation. You do so.
okay, thank you. Another question that's asking about mortgaging the deposit, but another, which we've just answered, but another one, just part of the question to answer, Sophia, is didn't quite understand the situation of acquiring a mortgage without income. Please explain how this happens, giving an example.
So as an example, let's say you don't earn any income. Let's say you have assets in the background, but as such, you're not really generating a fixed income. So it's very difficult to demonstrate any income for you. We will base the mortgage assessment on the rent that the property is going to generate. From that, we will then provide those figures to the bank, and then they will then be able to give us a mortgage offer. Essentially, they'll be able to confirm how much you can borrow, and then they'll be able to carry their assessments out purely on the rent that the property is going to be generating and nothing else. That's essentially how it works in short.
Yeah, thanks, Sophia. And I think we'll leave it with this last question here. I'm a master's student and intend to start working in the UK after completion, and I want to invest in a property with a mortgage for a house. Is that possible? So essentially, it will be possible if you've got the deposit to go by. If you get your visa to go and work in the UK, if you're not already there, you would benefit, and Sophia can go further into this, you would benefit when you get your indefinite leave to remain. Your mortgage options do become a little bit more favorable, and you will have, you'll have that benefit of being a resident in the UK, which you would want to take advantage of, Sophia.
Yeah, absolutely. So I think whatever your circumstances are at the time when we start the application will then determine, you know, what mortgage options are available. Are you in the UK, or are we starting it from whilst you're overseas? If you are in the UK, how long have you been in the UK? What is your visa status? How long do you intend on being there? Is there an employment contract in place whilst you're working? Or if you're a student, how long are you there for? Is it just the 1 year and then you're going back? So ultimately, all those factors play a role in determining what the mortgage would look like.
Okay, thank you, Sophia. I think we'll leave it there this evening, but I would encourage you, if you want to know more or book in a consult with our team or Sophia, we will make ourselves available. As I mentioned there, your minimum investment requirement on hand would just need to be just under £30,000 to consider investing with any of our products. So keep that in mind. But essentially, we're here to help and guide you through the process. And hopefully, yeah, we'll have you as a client of ours for many years to come, with us assisting you growing a portfolio. You will receive an email, or we will reach out independently if you have requested a meeting to schedule that time. But just to say a huge thanks to Sophia for joining us this evening,
Sure.
Gillian for your insights. Very, very, very cool of you to help us with that. But essentially, thank you, everyone, and thank you, Sophia.